You don't need to be rich to start investing. You just need the right plan. Whether you have $50 or $500, today I'll show you exactly how to start investing step by step. There will be no confusing jargon and no risky shortcuts, just a clear path to get you started. First things first, what even is the stock market? Think of it like a giant online marketplace. But instead of buying sneakers or a new phone, you're buying tiny pieces of real companies. When you buy a stock, you become a part owner of that business. So when that company does well and its profits grow, the value of your piece grows right along with it. That's the core of how investors build wealth. They own parts of successful businesses. So when you hear about someone owning Apple or Tesla stock, it means they literally own a tiny slice of that company. So how do you actually buy these slices? You need a special account called an investment or brokerage account. It's just like needing a bank account to save money. If you're in Canada, you'll hear about TFSAs and RRSPs. In the US, it's usually a Roth IRA or a standard brokerage account. Don't let the names scare you. They're just different types of accounts with their own tax benefits. The best part is you can open one online in about 10 minutes with trusted platforms like WealthSync, Questrade, Fidelity, or Vanguard. It's as simple as opening, funding, and then you're ready to invest. All right, your account is open. Now, what do you actually buy? This is where most beginners make their first mistake. They try to find the next big thing, the next Tesla or Nvidia. That's like gambling. Instead, I want you to think about buying something called an ETF, which stands for Exchange Traded Fund. Imagine an ETF as a pre-packaged basket of stocks. Instead of trying to pick the one winning product at the grocery store, an ETF lets you buy the entire store. The apples, the bread, the milk, everything. One purchase gives you ownership in hundreds of top companies like Apple, Google, and Microsoft all at once. This automatically spreads out your risk, which is a strategy called diversification, and it's key to long-term success. Now for the secret sauce that truly builds wealth over time: automation. The goal is not to perfectly time the market, buying at the absolute low and selling at the absolute high. Almost nobody can do that consistently. The real secret is time in the market. The best way to do this is to set up automatic investments. You can start with as little as $25 or $100 every week or every month. This strategy is called dollar cost averaging. It sounds fancy, but all it means is that you invest a fixed amount of money on a regular schedule. When the market is down and prices are low, your money automatically buys more shares. When prices are high, it buys fewer. This simple habit smooths out the bumps along the way and is far more effective than trying to guess what the market will do next. Remember, consistency always beats timing. As you start your journey, there are a few common traps to avoid. First, don't panic when you see the market go down. Dips and corrections are a normal part of investing. They happen. The worst thing you can do is sell in a panic. Second, only invest money that you won't need in the near future, like for next month's rent. The stock market is for long-term goals. And third, please, do not follow random stock tips from social media. Real investors don't guess. They follow a disciplined plan. Stay calm and stay invested. If you stick to this plan, something amazing happens. Let's say you invest just $100 a month. So, the key is to start small, stay consistent, and remember, real wealth is usually built quietly, not quickly. If you found this guide helpful, make sure to hit that subscribe button. Let's grow our money smarter, together. Thanks for watching.